Hey guys, what is up? It's Arthur here and welcome to this video in which we will take a look at Procter Gamble, stock ticker PG, and see how their business is, how are the fundamentals and the financials. Procter Gamble is a company that I have came across a lot, especially when I was looking at dividend aristocrats, but we are in this video not looking at their dividend strictly, but how the business looks like that has that magnificent track record of dividend payments. Now, if you don't know what Procter & Gamble is, we're using MarketWatch. We can scroll down and they have like a little summary about what this company is. Procter & Gamble engages in the provision of branded consumer packaged goods, operates in the following segments: beauty, grooming, healthcare, fabric and home care, baby, feminine and family care. Beauty segments offers hair, skin, personal care. There are blades and razors, shave products, appliances, oral care products, toothbrushes, toothpaste, personal health care, all the different vitamins, minerals, supplements. There are fabric enhancers, laundry additives, detergents, a lot of everyday stuff that people use. And how much everyday this is, you can see the beta is 0.51. Now what beta is, you might be wondering. Beta tells you how volatile this company is compared to the market average. The market average is 1. If you see a beta that is lower than 1, then the swings that you see on the stock price chart are gonna be less. So even if there is like a big uptick, a company that has a lower beta than 1, that uptick is gonna be much smoother. But the same applies to when there is a crash, because in the case of Procter & Gamble, they sell everyday goods that people need regardless of what the economy is doing. It is a very stable industry to be in. Okay, so I have prepared a 10-item checklist that we're going to go through. First one is 5-year revenue growth. So for that, we're going to go into the financials, and this is the income statement. Right, the first line is how much money they made selling their goods, and this went from especially like 71 billion all the way to 84 billion. Very nice trend, very progressive, smooth growth. So we like that. That is definitely a check mark. And then working our way down the list, we also want to see net income grow, which is what they have left after they paid all the expenses in connection with selling that bottle of laundry detergent or whatever the case might be, up from 13 billion to 14.8 billion. Not that much growth as compared to the revenue. We can see revenue was up 18%. Net income is only 14, but it's still a growth, so that's a check mark. And then moving on, we can, now that we know what the net income is, I calculated the 5-year average. You can see it in the top right corner of the second card. The average is 14.3 billion. Now, price to earnings ratio gives you a ratio that tells you how many years of net income the company would need to make up for its market cap. The market cap being 406 billion. And if we divide that by the average 14.3 billion, we will get 28.35. We would ideally want this be below 20 for it not to be expensive. So this is an X. But in case of like companies that grow a lot, or they have some sort of premium about them, some very strong competitive advantage above others, that might deserve a premium. I'm not sure about a 28, but we will see how the rest of the items look, and then we will see. What I also like to do is look at the industry median price to earnings, just to see where their valuation, where their price is in connection with other companies. And this is for the industry median 31. So Procter & Gamble currently is under that, so that's a check mark. You can get this number from various sites. I use TradingView. You can look up the individual company, and you can, on the breadcrumbs, click the most subcategory, and then you will see a lot of competing companies, and you can just get the average of their PEs to see what the industry or their peer competitor average is. Now, fifth metric, we want to look at 5-year return on invested capital. What money gets put into the business, how much money they are able to generate off that. In Procter & Gamble's case, that is 17%. Market average is 9 to 10%, so that's another check mark. It's not a huge number. In the case of Apple, we have seen somewhere around 40%, which is really, really good. This is good. It's above market average. I don't know if it commands a mighty premium looking at the PE ratio. That was an X. But this is only just a slight slice of the picture that we're looking at, but it gives us a good starting point to see whether we should look further into this or not. Now, sixth metric, one of my favorites to look at, is going to be the 5-year shares outstanding. We want this going down because we want the company to be buying back shares and giving you a bigger slice of the pie. You can find the number of shares in the financial statements, income statement. You scroll down to the section where they are essentially telling how many ways they have to split the profits. I take diluted shares outstanding, and we are down from 2.6 billion to 2.47 billion. So that is good. That's down 6%, which is a check. It's not a whole lot, but they are doing it in a very reliable and consistent way. So that is always good to see. And then next item on the list, we want to look at whether the increase in revenue that they are achieving, whether that is funded by taking on more debt or just by doing good business. Now, you would go into the balance sheet for that to check total long-term liabilities that I have abbreviated LTL, long-term liabilities, might not always be listed. It is under the second section, liabilities and shareholders' equity. You have total current liabilities and you have total liabilities. Total long-term liabilities is somewhere in between, but they don't sum it up. So what you do is you take total liabilities, deduct the total current liabilities to get the total long-term liabilities. I have calculated that and on my stock sheet, and we can, when you take a look at that, we see that it will be down 6.5% compared to the 18.4% revenue growth that we see in the first card. So that is actually very good. They managed to grow their revenue while decreasing how much debt they need to run their business. So that is very good. Now, next up, we want free cash flow to grow because that is cash out, cash in. So the amount of cash they get, the amount of cash they have to give out, this is what is left in the business afterwards. And we want this to grow as well because there are 5 things that you can do with your free cash flow. You can pay out dividends, you can buy back shares, you can buy other companies, you can reinvest in the business, and you can pay down debt. So those are all very good things to do, and you would want more money to do that, ideally. How you get free cash flow? You take net operating cash flow from the cash flow statement, and you're gonna add capital expenditures, which is a negative number. So essentially you're just gonna take the difference of the two numbers that you see in absolute terms. So 17.4 billion plus minus 3.07 billion. You do this for all the years and you would get that the average is 14.76 billion, and that we are up from 14 billion to 16.5 billion, up 15%. So that is again a check mark. Lovely to see. And now that you know how much money, how much cash the company has in an average year, you can take a look at that long-term liabilities that you calculated, and you can divide that by the available cash in a given year to see how many years it would take to pay that off. In Procter & Gamble's case, that would be 2.59 years. That is good. We want this to be under 5 to give the company a nice reassuring position and confidence, comfortability, so that they can pay out those debts even if something comes up along the way. They have cash to do so and they have room to maneuver, so that's something we'd like to see. That's another check mark there. And approaching the final one, this is a bit of a tough metric to wrap your head around, so if you have any question, the comment section is there to ask. I will try my best to help you out. We want to take the 5-year average free cash flow that we calculated, 14.76 billion, and we're going to take the market cap and divide that free cash flow with it. Market cap again being $406 billion. You divide that by the 14.76 billion free cash flow, and you get that if you buy the company right now, we can talk in terms of shares, but I like to keep it based on the whole company because you are becoming an owner of this business, so it's a lot more than just buying a ticker symbol. So if you buy this company at $406 billion today, it will take your money 27.5 years to regenerate it in terms of free cash flow in the business, with which you can do all the 5 amazing things that we talked about to generate value in this business. Now, 27.5 for price to free cash flow. We also would want this to be below 20 so that the money that you put into this company will see a return in a reasonable time. Now, if the company is growing a lot and has a lot of future growth potential that they can capitalize on, you would pay a premium. I'm not sure in the case of Procter & Gamble. Anyway, that is going to be an X, just so we can round up the list. I'm not sure in the case of Procter & Gamble. I get that they are a household brand, not Procter & Gamble, but all the products and various brands that they have are household brands, household names. But I'm not sure there is that much growth in this that it would justify paying like a 27, 28 price to free cash flow, price to earnings ratio here. Yes, if you always take, it is, we talked about it as a nice, consistent, growing revenue, net income. Free cash flow is a bit all over the place, but if you take the last year's values, you can get better ratios. But I like to smoothen out these short-term distractions and volatilities by taking 5-year averages, and that tells me that this company is a little bit overvalued. And for it to be a 20 price to free cash flow, it would need to be, the company should be worth around 295 billion, which is a 27% cut compared to the current price. And if you would want to equate that to something that is tangible, the share price would have to be around 127, while it is currently at 174. So yes, a cutoff of 27% would be nice to see. This is where Procter & Gamble is at the current time. 8 out of 10 check marks. Bit expensive. There is some premium to pay for this potentially. We don't know what the premium is. That is the fascinating part about investing, is that you have to come up with your own assumptions to justify these or say that it is too expensive. For me currently, I think this is too expensive and is not worth my money. But if you're looking for some defensive stocks where you can at least have your money grow at a certain rate, this might be something to look into, but there also might be some others where your money could do more work for you. Let me know what your thoughts are on Procter & Gamble. We can discuss that in the comments. I thank you for your time, and I hope to see you in another video. Bye.